good to be here once again. Now, one of the reasons why a lot of traders make mistakes when taking trade in the market is simply because you ignore top-down analysis. Now, every time you do top-down analysis in the market, you literally minimize your risk exposure. And this is exactly what I want to do in this particular video. This is gold, all right? If you've been trading gold, you will know that for the last 2 weeks or 3 weeks, gold have just been bullish. And now it is important we also take notice of that because it will help us to do top-down analysis correctly. Now, there are two things that top-down analysis helps you to do. That is actually guessing your directional bias correctly and also minimizing your risk exposure. You cannot ignore this if you want to be profitable in trading. So let's get into it. This is gold. I will be starting from the weekly time frame. Now, did you realize that gold have traded to its all-time high in history? All-time high in history. Look at what has happened. Boom. This was the all-time high in history before this one. But did you see price actually breaking above it? Massively bullish. And it's important we do that. Now, let me show you why price will find difficulty in going further up. It is simply because there is no liquidity, guys. There is no more liquidity for price to chase. And after you've cleared everything here that is looking like a liquidity, what do you do next? You look back for where you can find liquidity again or a cheaper price levels to go up further. Do you know that there are two forms of liquidity basically in trading, and especially ICT concepts? Now, let me show you that. If you have price moving in an upward direction, boom, boom, this is how you can spot liquidity. Liquidity is basically resting above this high. The moment price creates this high and retraces, what do you think price does? It left all the buy side liquidity here, right here, all right, in form of what? Buy stops. So all the people that decide to sell this retracement, they have their buy stops or simply stop losses here, and that is what you call liquidity. So these guys, if you pick every single of this liquidity, it is called external range liquidity. So if price is coming inside to either a fair value gap or an order block, it will come to an internal range liquidity before pushing up. So price will always take out external range liquidity and seek for internal range liquidity. Take out external range liquidity, which is here, and seek for internal range liquidity. So I hope you're understanding this. Internal range liquidity, external, internal, external, internal, before it finally shifts direction, starts the same pattern again in the downward direction. So why am I showing you this? I'm simply showing you that so I would be able to properly explain what is happening to gold right now. So price have moved up. What is this? External range liquidity. You know, I want you to look at liquidity as food for price. It's literally what we call food. The only reason why you look for a restaurant or you look for somewhere to eat food is because you are hungry. And if you are hungry and you finish all the food that was given to you, what do? You rest, you know, or you can exhaust all the energy you've gotten from the food before you look for another one. So this is it. Price, boom, it move up here, eating all the food, the liquidity here, and then we are now looking further to come backward. Now, this is the normal law of trading. Do not buy when it is expensive. Do you buy here, guys? Who is buying here? The only person buying from here is those people who are uninformed in the market. They don't know what is going on. That is why they make attempts to buy from there. This is normal law of demand and supply. The only time the average person knows that yes, there is opportunity in real estate, there is opportunity in this industry, is when it is fully visible to everybody. And the world doesn't work that way. Every time you see an opportunity, it is already too late. So you pick, or you can discern an opportunity since from here, and boom, opportunity doesn't always look like an opportunity. So if you want to take advantage of this, you can start selling it into this area. Now, if price is coming, remember we said we have internal range liquidity. Is this not a fair value gap? What is a fair value gap? It is simply an imbalance in price action. An imbalance in price action. When you have the high of this candle and the low of this candle unconnected, you have an imbalance. All right, you have an imbalance. So price will want to come and balance it, at least to trade into it before taking up. So this is an internal range liquidity. This was external. So if we push down, we have left an external here, so we can clear it out in that place. So this is the weekly. If we drop down to the daily time frame, we still have the same thing now, but in this case we are not going to use the same price delineation we used in the weekly. Because why? Because this is bringing us closer and closer and closer to what we call the microstructure. All right, so every time frame has its own structure from where you are looking at it. So this is it. On this regard, this was our shifting structure, because price have actually shifted structure to the downside here, trading into this area, but boom, you have shifted structure again to the upside. So all this movement in the microstructure, you can actually see it going up. So at this point, you can see that price is already overbought, or what other is already overbought. Let me use the retail term. All right, this is hard for people to buy again. It's hard. So the best thing to do is for price to come back where discount. Now guys, is discount. Price to come back to discount. Coming down to discount, where precisely? In the discount area, the places that have an institutional reference point will hold more relevance than any other place. Look at this place. Let me show you this. Look at this place. Can you see the price action here? The only thing that this place has is this fair value gap that was untraded. Apart from this, every other single fair value gap here has been traded. Okay, and this one, there is a very small one here. All right, but aside from that, in the PD array, there is something called a PD array, and it is basically the sequential arrangement of all the 7 institutional reference points in their order of importance. All right, so in the order of importance, you have what? You have mitigation block. All right, mitigation block. Is that how you spell block? No. And then you have a breaker block. All right, you have a liquidity void. Let me call it a liquidity void. You have a fair value gap, or simply FVG. Then you have an order block. So order block is even the 5th when it comes to order of importance. And then you talk about things like rejection block. And then you talk about old highs and old lows. Old highs / old lows. So this is the arrangement of all the 7 institutional reference points in order of importance. So what do you see here? As price comes, now immediately when price enters your discount area, you begin to look out for this. Do you have a mitigation block? No. Do you have a breaker? Yes, you have a breaker. So this should be your point of reference as price is coming down. So notice what I'm doing here. I am on the daily time frame, but guys, look at how much time it will take me. This is 1, 2, 3, 4, 5, 6 days. But if I were to wait for 6 days for price to retrace back to this, that means I will stay for 6 days without taking trade. All right. And that is where I brought in the issue of counter trading. 6 days is too much of a time for me to wait, because I'm an intraday trader. I want to take my trade within a day and I'm okay. So I can simply say, okay, give me an opportunity to go bearish. If I can go bearish, I will take advantage of the bearish, knowing fully well that I have a point of interest here. All right. So this should be my point of interest. I don't want to take further sell trade when I reach here, but then I did not see the entry yet. For me to know that I can see an entry, I will need to drop down to the 1 hour time frame. This is the top down analysis, guys. You need to keep dropping down until you see a bigger opportunity to take the trade. So in the 1 hour time frame, all I need is a shift in market structure to the downside, telling me yes, that the downside movement has started. And now this is how price moves, guys. When price move up, all right, when price moves up, before it starts going bearish, it will range. and start going bearish, or it will continue upward. That is what is in the secret of this. Every time a trend wants to end or wants to take a rest before going up, it will range. So this range will determine where price is going to. All right. If the range finally breaks lower, like boom, then we expect price to go bearish. But if the range decides to break upper, price is going upward. So look at this. The last price push up was here and the lowest was here. So for me to say that I can start bearish, I need to see price clear out this guy. And in the interim, I will see maybe a fair value gap or maybe an order block to go bearish. So what you need now is patience. What you see happening here is basically a range. And if you go to the lower time frame, you will further see it clearly. All right, the same thing happening right here. So where are you expecting price to clear out? You see, low here, but we created another low here. We created another low here. We did not break structure or shift structure to the lower side. The only time you shifted structure is when you finally close with the body of the candle below here. But look at this. Is this a valid shifting structure? No, because we have pushed below it, but the body of the candle did not close below here. So at any point now, when we break lower than this is my shifting structure. If I shift structure from here, that is, if I see price closing below here, I will look for an opportunity to sell. And the sell is going to reach where? The sell is going to take a long time sell. All right. The sell was to target where? This area I showed you on the daily time frame. This guy. I am doing that because I know I have already reached all the things I need to reach on the higher time frame. I've cleared the external range liquidity and I am now done with it. I want to see price come back here, and that is the only basis for this top-down analysis. So if I'm taking trade from this, I will not be so much exposed to risks. My stop loss will definitely be above here, all right, or maybe here. So if I'm getting stopped out, I'm getting stopped out at a low risk. But then if this trade moves in my direction, it means I'm going to get bigger risk to reward. If I can hold it on, price will take these, but then boom, I'm going to get massive risk to reward. Guys, this is all about that.